Last week was an interesting week, and this week seems as if it may be equally as interesting. So I thought it was worth reflecting a little bit on what happened last week across a handful of indices and have a look at what is actually happening in terms of the structure of these indices. So what I want to do is begin with having a look at the comparative performance of US indices year to date. And as you can see, US markets began the year slightly positive. Since then, it's been downhill ever since. The standout here is the Nasdaq 100, which so far this year is down just over 21%. And if we have a look at the drawdown in the Nasdaq 100, we can get a sense of the depth of that drawdown. It's not the most extreme it has been in the last decade, but it is certainly one of the more notable drawdowns that we've seen. And this raises the question as to what is powering this drawdown. And what we're seeing so far seems to be an unwinding in parts of what is, let's say, a bull market that is more than a decade old. And if we look at the breakdown of stocks within the Nasdaq 100, and we have a look at their performance year to date, you see something really quite interesting. What I have here are two tables. The one on the left is top 20 drawdowns for Nasdaq 100 stocks year to date. And you can see where the damage is being done. You can see that there are some very, very big names taking a hell of a belting, particularly Netflix, which seems to be coming apart at the seams. But to that we can add PayPal. Intriguingly, we can add Zoom, the Australian stock Atlassian, Meta. They're all taking a belting. And so you can see that when you look at this sort of population, it's quite easy to understand why when you look at the drawdown curve, it looks like this. We also need to reflect upon what's occurring with stocks that are not being so heavily sold off. But what is interesting in the Nasdaq 100 is these are the only 15 stocks that are positive year to date. So when you balance these two things together, that the vast majority of stocks are underwater for the year, there are very few stocks trying to carry the day, it is to be expected that you would get an index that is starting to shed points at a very, very rapid rate. What is interesting as a tangential exercise is to look at the impact of weightings within an index and the impact they have upon how an index performs. What I've done here is compare two ETFs. The first is an ETF that directly represents the Nasdaq as it exists, with its inherent internal weighting. The second represents the Nasdaq as if each share was equally weighted within an index. The important thing to note about indices is they're not equally weighted. Weighting is assigned on the basis of a series of variables. So one stock might have a disproportionate impact on the index compared to another. What you can see here is that an equally weighted index has a lesser performance than the traditionally weighted index. What this indicates is that within an index, damage is done by a collection of stocks. However, we do have the rather unique position with the Nasdaq 100 to note that most of the stocks within the index are underwater. If we were to, say, take a slightly different index, such as the ASX 200, within the ASX 200, the top 20 exert most of the impact. So it would be quite possible within the ASX 200 for those 20 shares to be going down, 180 to be going up, but the index would still be going down. That is because of the disproportionate weighting of those top 20. This is one of the inherent little glitches or quirks within the way indices are constructed. But this brings me to another tangential point. It really doesn't matter how the damage is being done. If your portfolio or system or approach is based upon following a broad-based index, then to you it really doesn't matter why the index is falling. All that matters is the index is falling. If, for example, you were the holder of a Nasdaq ETF or a Dow ETF or an S&P 500 ETF, it wouldn't matter to you that the reason you are losing money is because of a handful of stocks. All that matters is the overarching concern that you are losing money. But if we take a closer technical look at the Nasdaq 100, we start to get a sense of what the current situation actually represents. This is a weekly chart. The moving average through this is a midterm. I think it's 45 periods. There's a standout feature here, and the standout feature is the recovery in the market post the initial impact of COVID. But this acceleration comes at the tail end of a bull market that, if we look at it in very, very broad terms, really does stretch back almost 2 decades. And this again leads me to this point that part of the freneticness we see with people at present is a function simply of the fact that they've never seen a market go down, and they've never seen it go down so savagely. They're not used to looking at a list of Nasdaq 100 stocks and seeing that most of the index is underwater. So that's a new experience. And like all new experiences, it's somewhat shocking, and it does tend to derail the risk management and investment process that these people had. But the point I would make is they generally don't have a risk management process because it's not been needed. It's like the old sort of argument that you don't really need a parachute until you need it. If we look at the daily approach to the Nasdaq, there's a few things that stand out. You have this failure of the market at just under 17,000, this blocking that we have. Price then moves down, attempts to recover against the tide of the longer term chart falling. And we then have this base formation where the US market ended on the weekend. But the central issue here is that there is a tendency of traders to ignore what the longer term trend is telling them. So if we go back to our weekly chart, you see that the overall trend of the market since the beginning of the year has been down. So if you're attempting to trade this counter trend bounce here, you're doing so against the actual flow of the market itself. So it's not surprising that any attempt to go long into this move would have met with failure because you're struggling against the tide. And as we've seen, the tide of value coming off these stocks is very, very, very energetic. The same appears to be true for the S&P 500. And when I quickly glanced through the year-to-date performance of the S&P 500 stocks, there are 357 of them that are underwater this year. So it is hardly surprising that the index is struggling. Again, when we look at the index, there is a single standout feature. And it's the same standout feature we saw in the Nasdaq. And that is the continuation of the almost ever-present bull market that the US has experienced. And again, we're back to that issue. People who've traded S&P 500 stocks have not seen this before. And if you've gone through a list of the S&P 500 stocks, put them on a long-term chart, and just walk through all of them, you'll see what I mean. Whilst you don't want to be dismissive of people or arrogant in your perception, you've really done poorly if you've not been able to make money out of the US market, particularly in the past, let's say since the GFC. If you've not been able to pick winning stocks, then there's something seriously wrong with your methodology. If we look at the S&P 500 on a daily basis, same thing, peak, fall away, counter trend move, market falls away. Again, we now have this basing formation where they finished on Friday. And again, if you attempt to go long into that retracement, then you've really only got yourself to blame because you've not referenced what's actually happening with the longer term market. And this is an issue. What happens with traders is that they have a remarkable degree of myopia in that they can only see one thing. And there is an inability to step back and to view what's actually happening in the broader scheme of things. What's actually happening in the wider world, not the tiny bit of the world that I look at, but the wider world itself. Because it is the wider world that dictates what will happen to my very, very granular approach to the market. The key with the S&P 500 and the Nasdaq, also the Dow, are these basing formations we're seeing. If they're unable to hold, then there is substantial downside in these markets. However, the only sort of counterpoint I would make to that argument is that when you look at the Nasdaq 100 as we did, and we looked at the raft of stocks and the damage that had occurred to them, it would be interesting to envisage how much more damage you could do to the components within an index. There is only so far they can fall. Granted, there is always the theoretical argument that they can always fall to zero. There is also the ever-present notion that stocks will fall further than you could ever imagine. But again, there's already been a great deal of internal damage done. This doesn't mean by any stretch of the imagination I'm positive the index. I'm not. My orientation is bearish. But we also have to be aware that there are other points of view out there and that our point of view regarding the market might not be the correct one. We always have to ask ourselves the question when we trade, what happens if I'm incorrect? What happens if I'm wrong? What will me being wrong look like? What form will that take? And more importantly, how will I react to being wrong? In the short term, if we look across the Dow, the S&P 500 and the Nasdaq, and we look at the number of stocks that are below various length moving averages, you see something interesting. You see that they're all tanking, particularly in the mid-term. But what is interesting is the number of stocks in the Nasdaq. We get this reinforcement of what the performance is. Dow is slightly better. S&P 500 sits somewhere between the two. So in terms of what you're seeing here is collapse within a sector. Let's call it the technology/entrepreneur sector. This is then bleeding into the broader average of the S&P 500 because many of these stocks are replicated in the S&P 500, but they are not replicated in the Dow to the same extent. The Dow is a very idiosyncratic index and is not truly representative of the US market. To get a true representation, you have to drift to higher level indices like the S&P 500. This leads us to the local market. And what I've done here is just popped up the past 5 trading days for the All Ordinaries. And we had a week that started weak. Tuesday was weak. Wednesday was less destructive. Thursday bounce, Friday bounce. I've highlighted Friday because this in no way sees the overnight action in the Dow on Friday or the US market on Friday. So Monday's opening, particularly Monday's opening of the SPY contract, will be very, very interesting. My expectation is you'll see these gains wiped out very, very quickly because it's difficult to see our market holding in face of such a fall on Friday night. If we look at the technical aspect of the All Ordinaries, this market, when we look at it initially, seems to be different from the pattern we saw with the Nasdaq and the S&P 500. But there is a nuanced argument in here that is often missed. If I was looking at this and simply compared it to this, the Nasdaq 100, I'd simply go, well, we haven't in any way, shape or form enjoyed that sort of very, very smooth ride up. Our ride up has been quite bumpy, quite jarring. We've attempted 3 times to approach 8,000 points. It's been rejected every time. And so we have a different market, and we do. But I think the direct comparison of index to index in terms of saying, well, this index represents completely this country and this index represents completely that country is a flawed and superficial argument. It doesn't take into account subtle differences, and that will become apparent in a second. So if we look at a closer look at the All Ords, we've got that rejection towards 8,000, which seems to be fairly consistent. We have an upward sloping trend line, the value of which, in the face of what is to come, is fairly doubtful. But at the end of the chart, we can see our Monday, our Tuesday, our Wednesday, Thursday recovery, Friday recovery. That will undoubtedly unwind early in the week. Now, I mentioned this notion of comparing index to index as a full and true representation of what occurs, let's say, let's use the expression investing environment. And you could say, well, the Australian market really hasn't performed as well as any of the US markets. And if we were just to look at the All Ordinaries or the S&P 200 versus their counterparts, that would be a true argument. But it lacks subtlety and it lacks nuance, and I think it lacks an understanding of what really happens within the Australian investing environment. This is the ASX Small Resources. And since the pandemic dip, the Small Resources Index has more than doubled. It has clearly been a standout performer. And we can see this when we look at small resource stocks and their performance over the past 2 years. And there are some strikingly powerful performers in here. So what you have is this notion that when you look at the All Ordinaries or the S&P 200, you're seeing a portion of the Australian market, and you might not be seeing the portion that is working. For example, if you were to look at this, you would simply say it's not working. You're drifting sideways, you're going nowhere. But if you were to look at this post the initial pandemic drop, you would say it is working and we are not drifting. The components within this index are doing very, very well. And if you pull this index apart and you walk through how its components are doing or have done, there have, as we've seen, been some staggering performances. And these are performances that match any stock in terms of gains anywhere in the world. Granted, it is being driven largely by the perceptions of a single entity, and it is perceptions around lithium, rare earths, and their take-up for the new emerging battery-based technology. And I mentioned that when you look at the broader index here in Australia, you don't get this sort of picture. You actually get this sort of picture. These are top 20 stocks by market capitalisation and their one-year performance. And you can see it's a very, very mixed bunch. The best performer has been South 32, followed by Woodside. But they've not been standouts. They've been solid, but they don't stand out. And there is a lot of red in there. So this brings me back to this notion that we have a two-tiered or a two-phased market. We have one that is represented largely by the performance of our broader indices. We have a second tier that is represented by the performance of our smaller indices, which in turn, to my way of thinking, is perhaps more representative of the investment gains that are possible within our market. So you have this schism, and it is that schism, I think, that confuses people, that they look at a chart of the major index and they say it's going nowhere, and they look at the performance of these entities and say it's going nowhere. Well, in many ways, they've missed the point, because markets are more than their leaders. And disruption or great profit gain does not come from leaders. It never has and never will. And I think in part what confuses people is that they'll look at US stocks that are $300 and $400 and they then double, and they think, well, we have stocks that are, whilst not as expensive, they're still getting up there in price. They should double as well. They're missing the notion of the different psychology of markets and the different size. The Australian market has a different psychology than the US market. And that's reflected in the gains you see in the segmentation of those gains and where they come from. You're not going to get a situation where you have CSL making, over the next 2 years, a 2,000% gain. That will never occur. So if this is your environment, if this is the pool within which you play, you really do have to ask yourself the question as to why you're playing in that pool. There are reasons to be playing in that pool, and they are true and correct for different individuals. They are the need for, I don't want to use the term capital certainty, but a different perception of risk. There is the need for the use of dividend reinvestment programs. So there is a rationale for people doing that. But if you're looking for outsized gains, you will not find them within the ASX 200. Now, many people will go, but you could find some of the outstanding stocks we've seen recently in the ASX 200. No, you couldn't. Because for the vast majority of their run, they were not in the ASX 200. They were not even in the 300. They were not even in the All Ordinaries. They've only appeared sequentially in those indices as their price has gone up. So by the time you've noticed them within the index or world that you deal in, you've missed the boat. So in terms of the broader aspect, let's talk about the index itself. There are two lines on this chart. The black one is the ASX 200. The red one is the number of stocks within the ASX 200 that are above their 200 period moving average. And this is a weekly chart. My preference is always to deal in longer term timeframes. You get much more data and you remove a lot of the noise that you see. So you get a much broader perspective. To use sort of the hackneyed management term, you get a 1,000-foot view. The standout feature here occurs from early 2021. You can see that within a closed index, such as the ASX 200, the number of shares above their long-term moving average has been falling. And at present, it sits around 45%. So half of the stocks within the ASX 200 are below their long-term moving average. You're not going to see great gains in the index with that sort of behaviour. So once again, if you're an index-based investor or trader and you're dependent upon the performance of the index, then you probably have very, very rough times coming. Contrast that again, we come back to this to harp on a point. The performance of the small resources. Again, we have this notion of two-tier or a stratified market. So in terms of the coming week, to wrap this up, this is a list of 5-day percentage change for stocks on the Australian market. These are stocks from last week and their 5-day percentage gains. Fairly simple table. My interest will be in how well these hold up and how well these sorts of moves continue. You'll notice again that this is a resource-heavy list. So it's not reflective of what you would see in the ASX 20 or 50 or 100. It's a different list. And it is more reflective, I think, of the investment or trading opportunities that you will see in the Australian market. In terms of the other end of the market, if we were to flip back to our heavyweights, my expectation is that these will undoubtedly bear the brunt of most of the selling that is to come, which is why my preference has always been at this end of the market. However, having said that, there are certain both mechanistic and behavioural things you need to be aware of in trading these sorts of stocks. They are much more difficult for people to trade. They can suffer from liquidity problems. They can move very, very quickly. So without the correct approach to stops, you run into trouble. There is a tendency for people to load up on these and play Tats Lotto instead of treating them as part of a trading portfolio. But my interest for this week will undoubtedly be these names which have popped up on my list. It won't be the heavyweights in and of itself. And Monday will be a very, very interesting day.